Hey everyone, and welcome to The Explainer. So if you've been following the AI space even a little bit, you know it moves at absolute breakneck speed. But, every once in a while, a headline drops that completely rewrites the roadmap for the entire supply chain. And today, we are decoding the reality behind Marvell Technology and Google's massive new AI chip partnership. We're going to peel back the layers, look past all the hype, and really understand what this truly means for the future of artificial intelligence infrastructure. Let's get right into it.
$12.2 billion. Wow. That is the sensational headline figure that immediately grabbed Wall Street's attention, right? The headlines made it sound like Google just backed up a Brinks truck straight to Marvell's headquarters and unloaded billions in cold hard cash to secure their AI future. And look, when you see a number with a B that large, it's so easy to just assume the landscape is permanently shifted overnight. But as we know in the world of high finance and big tech, the headline is almost never the whole story.
So let's actually dive into the mechanics of what went down here. Google didn't just hand over a $12.2 billion check today. What they actually negotiated is something called a conditional warrant. This basically gives Google the right, but absolutely not the obligation, to buy up to 58.97 million shares of Marvell at a very specific exercise price of $206.58 a share. If, and really only if, Google ultimately exercises that entire warrant, the shares would be worth roughly $12.18 billion based on that price. So it's not a cash injection at all. It's an options contract.
And here is the really crucial part. How does Google actually unlock those shares? Because this isn't just a free gift. Most of this potential equity stake is strictly tied to Google hitting massive purchasing targets over a really long timeline. We're talking all the way through fiscal 2033. In other words, Google's potential ownership in Marvell grows right alongside its actual commercial relationship with them. The more tech Google buys from Marvell over the next decade, the more of this warrant becomes available. It's honestly a brilliantly structured deal to align their interests, making sure Marvell gets real, tangible business before Google gets its equity.
To put this into perspective, let's zoom out for a second and look at the macro shift happening right now. We are seeing an absolute explosion in big tech AI infrastructure spending. We're talking about roughly $400 billion in 2025, surging to an expected sum of over $700 billion by 2026. That's enough money to make your head spin. The sheer scale of the capital being poured into data centers, power systems, and computing hardware is just staggering. And to capture a piece of that pie, hyperscalers like Google literally have to secure their supply chains years in advance. Now, to understand the specific tech involved in this deal, we have to look at how these massive data centers are actually evolving. On one side, you have the heavy lifters, general-purpose GPUs. These are fantastic, super flexible engines for AI computing. But when you're operating at Google's colossal scale, you don't always want general compute. You want custom ASICs. These are purpose-built, highly specific chips, like Google's own Tensor Processing Units, or TPUs. Custom silicon allows them to dial in and optimize specific workloads, which drastically cuts down on power usage and costs, all while maximizing performance.
Okay, but here is the plot twist. If Google is leaning this heavily into custom chips with Marvell, what happens to their existing partners? Because remember, Google already has a long-term, firmly established custom chip agreement with Broadcom, and that agreement runs all the way through 2031. So, the multi-billion-dollar question becomes, is Google preparing to replace Broadcom, or are they just diversifying their ecosystem?
Well, Wall Street immediately tried to answer that question, and the knee-jerk reaction was super fascinating to watch. When the news broke, Marvell's stock surged more than 11% in pre-market trading. Meanwhile, Broadcom's stock fell by more than 2%. Investors instantly interpreted Marvell's massive gain as a direct, existential threat to Broadcom's territory. But we have to remember, a stock reaction is just the market's immediate emotional interpretation of a headline. It doesn't actually prove that Marvell's long-term fundamentals have permanently changed, or that Broadcom is suddenly kicked out of the picture.
Actually, if we look closely at Google's overarching strategy, this isn't necessarily a replacement story at all. It's an ecosystem story. Why would Google want another semiconductor partner? Well, it comes down to supplier diversification. They just don't want to be completely dependent on one single company. Adding Marvell gives Google more engineering capacity, entirely different technological capabilities, and just way greater flexibility. When you are spending hundreds of billions on infrastructure, you absolutely need a robust, diversified network of partners. You can't afford a single point of failure.
And this diversification plays directly into what we call the second-order AI opportunity. Because designing the central processor, the custom chip itself, is literally only half the battle. To make an AI data center actually function, you need this massive surrounding infrastructure, We're talking about the networking, the optical connectivity to move data at the speed of light, advanced memory, and incredibly complex power systems. Marvell is perfectly positioned right inside this second layer. They provide the critical plumbing, so to speak, that connects all these AI systems together.
So, to properly evaluate this deal, we really have to weigh both sides of the coin here. The bull case is that Marvell wins more and more of these specific design opportunities, becoming an absolutely essential, indispensable partner to Google. That would generate massive, sustainable cash flow over the next decade. But the bear case is equally important to grasp. The custom chip market is intensely competitive. Broadcom isn't just going to roll over and disappear. And remember, that $12.2 billion is highly conditional. If Marvell doesn't deliver the goods, or if Google pivots its architecture, that money literally never materializes.
I really want to hammer this point home because it is by far the most common misunderstanding about this entire partnership. The $12.2 billion maximum value is strictly the value of the warrant if it's fully exercised. It is not guaranteed revenue for Marvell. The real economic value of this deal depends entirely on what happens in the engineering labs and the data centers between right now and 2033. If you take away anything from this explainer, let it be this. In corporate partnerships of this massive scale, performance dictates the payout every single time.
So how do we actually track if this deal is a success in the real world? Here is your actionable checklist of financial metrics that we need to monitor over the coming quarters. Number 1, custom chip revenue. Number 2, overall data center growth. 3, gross margin. Are they actually making this highly profitable? 4, free cash flow. And 5, and this is perhaps the most critical one, customer concentration. A giant customer like Google can dramatically accelerate your growth, sure, but if you become too dependent on them, your bargaining power just vanishes. These 5 numbers are going to tell us the true story long after the headline hype fades away.
Ultimately, this entire deal forces us to step back and reframe how we view the industry. For the last year, the media has framed the AI chip war as this simple battle of who can beat the dominant GPU makers. But that is honestly far too simplistic. The real, broader, strategic fight happening right now is over who controls the underlying infrastructure of the entire AI economy. Hyperscalers like Google, Microsoft, and Amazon are waking up to the fact that AI computing is just too strategically vital to leave entirely in the hands of outside suppliers. They want to control their own destiny.
As the world's largest tech companies increasingly design their own silicon and build these really complex ecosystems of partners rather than relying on single suppliers, the landscape is fundamentally shifting under our feet. As the source material puts it perfectly, today's biggest AI semiconductor winners may not be the same companies investors expect. It really challenges everything we think we know about the AI boom. Keep an eye on those second-order winners, everybody, because the custom silicon revolution is literally just getting started. Thanks so much for joining me for this explainer, and we'll catch you next time.